In this video, I want to go over capital budgeting utilizing, of course, our BA Analyst. And you may follow along. I'm taking this particular illustration example from problem 17 in, of course, chapter 12. And in this particular problem, we have a company, Hudson Corporation, has just made an investment of $24,000, and it has the following cash flows. Year 1, $13,000, year 2, another $13,000, and year 3 is $4,000. So we have 3 years of those specific cash flows, and what we want to be able to determine is the net present value of this investment and the internal rate of return for this investment. And we were given that the weighted average cost of capital, in the problem they refer to it as discount rate, but really what it is, it's a weighted average cost of capital of 8%, and that simply means it costs the firm to go out and raise capital, and that would be stocks, bonds, etc., 8%. So let's go ahead and let's set it up with the analyst. So the first thing that we want to do is CF, cash flow. So we just go cash flow. And when we do that, what we want to make sure, just like when we were dealing with time value of money, we wanted a clean worksheet. So the same thing with capital budgeting from the standpoint of net present value or the internal rate of return. We want to make sure we have a clean worksheet. So when we do that, in order to find out or to get a clean one, we go second, clear worksheet. Second, clear worksheet. Now we have a brand new worksheet, and that's always very, very important, just as it was in our time value of money calculations. So we want to go back to cash flow, and so it's asking us for the outflow. Cash flow, which is really a cash outflow, and that is $24,000. And since it is an outflow, we got to change the sign for a negative and enter it. Always make sure you enter it. We want to scroll down. Scroll down here, and it's asking us for, okay, what's the first cash inflow? $13,000. And of course that's positive. Enter. And we want to scroll down, and it's asking us for, okay, how many times will the company receive $13,000? And that's one time, so we will enter that. Scroll down, and it's asking us, okay, what's the cash flow for the second year? And that is another $13,000. That's positive, of course, so we were until that. Scroll down, and we're going to receive that, of course, one time in the second year. Scroll down, and it's asking us for the third cash inflow, and we will receive $4,000, and we will enter that. Scroll down, and we're going to receive that one time at the end of the third year. Enter. Okay, so we've entered our data, right? The cost of the project, we got the cash inflows for the first year, second year, and third year, and now we want to go ahead and determine the net present value. So NPV, net present value, and it's asking us I, the interest, or our weighted average cost of capital. Okay, so when you see I here under net present value, it's really our weighted average cost of capital, and that is 8%. 8, enter. Scroll down, and it's asking for the net present value. So it's saying compute. So CPT, compute, CPT, and we are given the net present value is $2,357, and we'll say 77 cents. We have a positive net present value. Any net present value greater than 0 will enhance shareholders' return. It's positive. So yes, this is a good investment to make based upon our weighted average cost of capital, and of course the cost of the projects and the inflows. For the internal rate of return on the project, we will go IRR, internal rate of return. And okay, it's asking us go ahead and compute it. Okay, CPT. And if we do that, the internal rate of return for the project is 14.31%, which again is positive. And the reason why it's positive because the internal rate of return of 14.31 is greater than our weighted average cost of capital, or that discount rate of 8%. So when we're doing these types of problems, we will get the same response for either net present value or an IRR. They'll both say it's either going to be yes, it will enhance shareholders' return, or it will not. Now, let me give a disclaimer here, and that's in regard to the internal rate of return. This is a pretty well straightforward problem. If we would have had a problem where we would have had, you might say, instead of a steady stream of cash inflows, but we could have had some outflows, say in the second year or third year, we could have a problem whereby we could end up with multiple IRRs. And that's one of the reasons why we choose in finance not so much to specify the IRR, but the so-called modified internal rate of return, which I will have a video that will go over because you'll have a problem dealing with the modified internal rate of return. They're both good. Net present value, the IRR, with a disclaimer, meaning, of course, in finance, we would rather utilize the modified internal rate of return rather than the internal rate of return as such. So hopefully this will give you an overview of how to utilize our analysts in capital budgeting problems, coming up with the net present value and the internal rate of return.